Now, the Federal Reserve is normalizing monetary policy. Financial markets, especially emerging markets, are far from becoming normal, with some unusual correlations taking hold. Bloomberg Emerging Markets editor Srini Sivabalan joins us now from our London studio. Srini, good to see you this morning. I mean, I look at the pre-trade war jitters, copper's under pressure, iron ore's under pressure. The EM complex is really beginning to be pushed and pulled in a whole variety of directions. What's the subplot? What's going on?
Yes, the EM strategies are deriving their cues from, obviously, the dollar and the US Treasury yields. And until 2 months ago, the world of portfolio management had assumed a linear relationship with Treasury yield, between Treasury yields and the US dollar. But what's happening right now, as you see there, is there is a negative relationship between US Treasury yields and the dollar. They are breaking away from each other. And that's a surprise. That's happening after a long time. And that's upending all strategies. And now you see emerging market currencies are positively correlated with Treasury yields. And this is the 10-year Treasury yield, but you can see this in 2-year Treasury yields as well. So what's really happening here is Treasury yields are not influencing emerging markets anymore because the dollar is. And the dollar is rising, and the US Treasury yields have failed to hold above 3%. So it's all about the mighty dollar now, and all the correlations have gone awry, and portfolio strategies are changing, and they're quickly changing to suit the dollar's moves rather than the Treasury moves.
When I try and think of sacred correlations, I think of Middle Eastern stock markets and crude oil prices. You've taken another look at this, and it's not really what it has been in the past, is it?
Yes, absolutely. This is one of the correlations we would have never expected to break down. That is the relationship between oil and Middle Eastern stocks. Now they're almost random. This box shows how when oil was rising, Middle Eastern stocks were falling, and here the opposite is true. Why is it happening? It's all because investors are now focusing more on flows and foreign investors' views on Middle East rather than the relationship with oil. Now you're seeing a lot of positivity surrounding Kuwait in connection with the MSCI inclusion. The same positivity you saw with Saudi Arabia a few months ago. Those views are based on the dollar strength, the dollar view, and foreign investor views, and oil doesn't matter anymore. And this is one of the curious things that's happening in emerging markets. We have seen that in Russia a few months ago. We saw that in markets like Angola, where oil is not able to benefit the local assets, even though these are all oil exporters. And the first chart showed us how the US Treasuries are no longer influencing emerging markets. This is showing how oil is no longer influencing emerging markets. So the moral of the story is that when things go wrong, it's the dollar that gets going. Investors put all the faith in one thing in this world, and that's the US dollar. It's the dollar versus the rest of the world now.
Srini, you've made grown men and women cry in the streets of the GCC that oil just doesn't matter to the local markets anymore. You've deconstructed some of the correlations, and well done on that. So with changing or unusual correlations changing, where are the biggest opportunities?
Yes, if there was a God for correlation, he closes one door and he opens another door, and this is it. Chinese bonds are now moving in the opposite direction to the rest of the world. The conventional view now is that rates are going up everywhere and yields are going up everywhere. And that's the mood that prevails in global bond markets. But China is moving in the opposite direction, where yields are falling. Why? Because the trade war concern is created a stimulative environment in China. The People's Bank of China is expected to be accommodative in order to combat the risks of trade war. And that's creating an opportunity for investors because you could hedge your exposure to US bonds by buying into Chinese bonds. This line is the correlation between the U.S. Treasury, U.S. bond index and the Chinese bond index, and that's negative there, and that's creating a small window of opportunity for portfolio managers to hedge their risk, and that's one of the reasons why money managers are touting Chinese bonds now.